Hi, everyone. Welcome back to another session at Park Launch, the FinTech landscape. This time, we're going to be discussing the lending layer. I've again got three stellar founders with me. All three are my portfolio companies, so I'm a bit biased, but I do think they're some of the best on the lending side in the industry. We've got Salman Akhtar, who is the founder and CEO of AdalFi. He's a seasoned industry veteran, where he's also created one of the formidable tech firms in Pakistan called TechLogix. So it's an honor to have him. Then we've got Omer Khan, who's the founder of PostEx, a young founder when he approached me about 2 years ago with a new innovative idea of a logistics fintech, which I think he's proven a brand new model. So I'd love to hear his perspective as well. And then last but not least, Omair Ansari, who's developed a powerhouse fintech called Abhi Finance that I repeatedly get asked about all over the world. So he must be doing something right. So gentlemen, what I'll do is starting with Omair, if you could give a brief intro about yourself and then also about your respective company, and then we'll get into Q&A from there, meaning Q&A between us. So Omair, I'll start with you.
Perfect. Faisal, thanks for the intro. I'll give a quick blurb on my boring background. So background-wise, I was about 16 years in investment banking across London, New York, Hong Kong, and a few other places. For the last decade or so, I was focused on fintech specifically. I was at Morgan Stanley in New York, helping run a fund and leading a fund focused specifically on fintech and emerging markets, and then sitting on the board of VEF, which is our largest shareholder, which is a VC fund focused on fintech and emerging markets. So that's my kind of history work-wise, and then obviously launched Abhi about just over 2.5 years ago in the midst of the pandemic. Figured if I don't do it then someone else will. So raised some capital, moved from New York to Pakistan to be able to launch it. We're essentially a B2B2C lending platform. We do everything from working capital financing for SMEs and companies in the country, all the way down to their employee bases by giving them access to their wages in real time as one of our core lending products. So that's us in a nutshell.
Thanks. Omer, over to you.
Thank you, Faisal. Thank you for having me. Founder and CEO of PostEx. Before doing PostEx, I was a professional football player, and then I jumped into professional studies, did my chartered accountancy from London, and then I was working in Dubai for around 4 years, did my CFA during that time. And in 2019, early 2020, I moved back to Pakistan to focus on PostEx. The idea was to help e-commerce platforms to give them access to capital. The biggest challenge that we saw for them was cash on delivery. So we started with receivable factoring for cash on delivery orders. And then we moved towards more like logistics and revenue-based financing or embedded financing for them.
Excellent. Thank you. Salman?
Great. Thanks, Faisal. So I have been sort of in the startup business before it was called the startup business. Started off a tech firm called TechLogix, which is an IT services company, which is still around. And that business has been running for about 25 years or so, give or take at this point. And one of the things that we did in that business was that we work with a lot of banks and implement solutions for banks. So over the last 10, 15 years, got a lot of insight into how banks operate, how, where the opportunities might exist. And that's what led to the creation of AdalFi about 2 years ago. So we are not a lender ourselves. We are a provider of infrastructure for lenders, which means specifically we do two things. We do credit scoring models for lenders, and we do the end customer journeys, digital customer journeys, to automate the whole thing from soup to nuts, essentially.
Amazing. Thank you. So I think I'll start with one of the biggest questions that I get asked when there's a down market, because 2021 was the year of fintech, just like in the past we've had. In fact, right now, AI is everything, right? So fintech was the same in 2021. So from each of you, I'd like to get a perspective. I keep hearing that fintech is overvalued and it has no use case in Pakistan. And obviously, I know otherwise because I see each one of you scaling and building pretty formidable loan books. But I'd like to get your take on why your particular vertical is viable. So Salman, we'll again go in reverse, and I'll start from you, especially, and I want you to kind of go in deeper a little bit into the your credit scoring engine perspective, because one of the main things that criticism we always get is also that a lot of the lending is still done in a manual manner, not about your fintech, but generally in Pakistan.
Sure.
But I know you've done some innovative stuff, so it's love to hear more about that.
So let's look at the Pakistan market on broad brush level. So there's about 150 million adults or so in Pakistan. About 50 million of them are banked customers. Another 50 million have mobile money accounts, Jazz and Easy Paisa. And the bottom 50 million probably have nothing, or even if they have mobile money, they've never used it, and so on. So this is the breakup of the 150 million. So out of the top 50 million, which is the bank customers, which definitionally are the people who are generally richer and have more access to money and income, etc. Even over there, if you look at the access to credit, depending on various numbers, there's between 2 to 3 million people that have access to credit in any form. Now we're talking about credit cards, talking about personal loans, we talk about cars, mortgages, you name it. All that put together, that's about maybe 3 million, if that. So that says clearly Pakistan is a very seriously underlent economy, right? And the question, which begs the question, why are we so underlent? And we are underlent even relative to, near kind of equivalents, like, for example, Egypt. So, for example, if you look at the consumer credit to GDP ratio of Pakistan and compare that to Egypt, Pakistan is sitting at around 2.5%, Egypt is sitting at 10%. So there's obviously something which was causing this credit access to be jammed up. And our hypothesis was that the cost of origination was way too high in this country. If any of you in the audience have ever, applied for credit to Pakistan, it's a very laborious manual process. Typically, takes about 2 weeks to complete for the bank, and that 2 weeks means a lot of cost. And that cost translates, that high origination cost translates into banks really trying to focus on people that they're very confident will qualify for the loans, which really means the top of the pyramid, which results in the situation that you have, that only 3 million borrowers out of 50 million account holders. So the whole idea of creating scoring models is to reduce that cost, ideally eliminate that cost or bring it as close as possible to zero. And that's what AdalFi focused on. So we tried to build these custom credit scoring models that work with banks and with NBFCs that allow them to take a view of their customers, which does not rely upon either survey-based data or self-reported data, but works on hard digital data that in some cases banks already possess, in other cases they may acquire from partners. So that in a nutshell is what the credit scoring model does. So really, because we are not ourselves a lender, so it's not that we are focused on any particular vertical, but broadly speaking, banks today are using us for two big pieces. One is the consumer lending piece, unsecured consumer lending piece, and the second one is SME lending. So they use our scoring models to give out loans in those two broad categories.
And I know this may not be your, given that your focus is more leveraging data to further build your credit scoring engine, which Pakistan badly needs because, as you can understand, psychological studies and a lot of these credit scoring engines that come from developed markets don't necessarily apply to our markets. Would you say that, would you choose in the long run to be an open API, like an Alexa in the voice domain, or would you choose to be like a Siri, stay within your ecosystem? Because obviously we've got other fintechs here that are aspirational as well on building a credit scoring engine. And sometimes I feel like that's counterproductive. So just wanted to get your take on that.
So, our view is, look, we just want to build the best credit scoring models in the world. So for us, all of these, whether it's a bank or an NBFC, so whether it's Abhi, PostEx, or some bank, we see all of you as potential customers/partners, okay? And it's our job to build the best scoring models that we can do because we have this very narrow focus. We're not in the customer acquisition business. We don't have to worry about that part that our partners worry about, whether it's a bank or an NBFC. So we just narrowly focused on trying to get, first of all, the scoring right, and then build the customer journeys that integrate with the digital presence. Now, that's not a big deal for fintech companies because generally they have good tech stacks or they build their own tech stacks. But in many cases for banks, that is a big deal. In other words, doing the automation so that you can actually give out loans in real time immediately. That's kind of the that's the second part that we as AdalFi address.
Excellent, amazing. Omer, I'll jump to you next. When you approached me, I think it was I couldn't find a comparable, which as a VC is not just justified because technically we're supposed to be betting on new ideas, right? And if you remember initially, the first time you approached me, I was very skeptical on the model, but that was very early on. There was an ideation stage, and then you came back, I think 6 months later, and I was blown away at the scaling you'd done. Walk me through what the whole concept is with collateralization and why an embedded logistics company versus just working with a third party. Omer, I'll get to that because you're doing the third party kind of working with BlueX and that element. So I'd love to kind of get that dichotomy between the two of you. But Omer, and just in general, your thoughts and what you're scaling and what you're seeing in e-commerce in terms of lending.
Faisal, when I approached the first time, so we had that, thought process where we can just do the receivable factoring because we're trying to be a fintech, where we can just provide the capital to e-commerce platforms and solve their working capital issue when we talk about cash on delivery financing, right? Because it was taking them 10, 15 days to get their capital back from courier companies. And we wanted to bridge that gap. So we wanted to solve that problem first because it was a massive problem. We were talking about an economy where 98% of transactions are cash on delivery for e-commerce platforms. We talk about digitization, but we need to see what problems these e-commerce platforms are facing right now today so that we can solve those problems and help them with the digitization rather than just focusing on one part of the equation. And when we talk about lending them or collateralizing them, we're talking about e-commerce platforms who are digital businesses. They don't have assets, so they don't own the warehouses. The only thing that they own is inventory. And if that is being stuck in the cycle for 15 days, 20 days, they can't really grow. They can't really make sales to their consumers or scale their businesses to a level where they can be profitable. They can compete with players like Daraz, Khadi, Gul. And how do they do that? One idea was where we just provide the capital and work with a courier company and let them do the logistics rather than getting into logistics because it's a very operation intensive business. It's a very complicated business. Or we take control of the full cycle of e-commerce platforms where if we are providing the capital, we take care of the logistics as well. So that we don't have any dependency on any third parties. Because when you start having dependency on third parties, their inefficiencies would be passed on to you because it's your capital that is being deployed. It's your capital that is being that is at exposure, not for courier companies. So unless they have skin in the game, they wouldn't really care how soon they're doing, what is the lead time for deliveries, how soon they can do those, how efficiently they move capital. Because whenever we look at a logistics player in the market, we see very old school SOPs, controls around cash and the way that is being managed. So those inefficiencies would have passed on to us as a business, as a player who was offering the same services to market. We wanted to solve the problem. We just didn't want to solve one side of the equation. We wanted to solve both problems because we have to control the experience. If they don't have good experience with us when we are doing the financing for logistics, they're not going to stick with us. They're going to switch from one player to another player because when you're solving their problem around capital, you need to make sure that their success ratio or return ratios are not going up. Success ratio is where it's better than what market is offering them. And that's how you create an experience for them so that they can grow, they can focus on the business, they focus on sales rather than chasing one player for capital and then vice versa, that we chasing them for capital or putting more pressure on 3PLs, where we did see a lot of inefficiencies. We didn't see expertise. We didn't see that understanding of how they should be settling the players so that they can run their cycles more efficiently. Because we're talking about where the lead time was from 4 to 6 days. If the lead time of delivery is from 4 to 6 days, that's the bare minimum when the product is being delivered and cash is exchanging hands between consumer and a courier company. So that we still see that gap. That's the reason why we decided to double down on logistics. So we can build the infrastructure, we can build the foundation, and on the top of that, we can solve problems that are around that for e-commerce platforms. The reason why we need to be doing stable factoring and then embedded financing and giving them access to capital is because, like I said, that these are digital businesses. They can't go to conventional financial institutions and ask for capital. Then we talk about how big e-commerce is. We see how it's going to grow in next 4 years, 5 years, or 10 years. But they would be needing access to capital. They can't be doing that by just making sales, right? It's not just about consumer making more sales online. It's about having more players in the market and the existing ones growing. And for that, we wanted to come in. We wanted to, we're not trying to be go up against conventional financial institutions. The idea is to bridge the gap where they don't have access to that kind of market, which that market is being neglected by financial institutions, but we see a lot of potential. But we don't want to be taking extra risk when we are serving that market. So that's the reason why we decided to go with a hybrid model where we control the logistics, meaning that asset is with us throughout the cycle, and all the transactions that we finance are backed by asset itself.
Amazing. And what would you say to some of your critics? I mean, I know this answer, you convinced me on this, but I think it's always important to discuss the flip side of an equation. A lot of people say that, look, COD is temporary and will disappear, and then your model will disappear with that, right? As we move to digital payments, I'm obviously on the other side. I can see the scaling, but I'm also not seeing that level of adoption on the flip side. So I'd love to get your take on that as well. And I know you have an evolution in mind, so we'll keep that in our back pocket in terms of what the long-term plan is, but would like to hear that criticism and your response to that.
So Faisal, we need to see what we're trying to do, right? So we're not trying to be a cash on delivery company. We're not trying to be a company that is just focusing on cash on delivery. We're trying to solve a problem for e-commerce. We're trying to bridge the gap between capital and the market that we're serving. Now, when we started, like I said, that we talk about digitization, we see digital payments growing at a very slow pace, but still we expect 5 to 10 years, we're going to see a shift. But if the cash on delivery is the biggest problem for e-commerce right now, who's going to serve them today? So you need to solve the problems today so that they can grow. I mean, if I talk about digitization and say, okay, once they start doing more digital payments, or if I'm going to start lending against digital payments, that's just 2-3% of the total market. That's just 2-3% of the total payments. So that's not going to be, that's not really helping them. That's just trying to build a product just so that you can scale maybe in 5 years. We want to solve problems today, and then we want to help them scale and then solve other problems, because that's not the only problem that they're facing. Cash on delivery financing is one product which contributes towards around 25 to 30% of our revenue. But then there is another 70% coming from different products that we're serving to these e-commerce platforms. So we have already, you can say, hedged us against the transition from cash on delivery to digital payments, thinking ahead of time, because we have to diversify our portfolio as well. But yes, that was our go-to market product, and that is the biggest problem that e-commerce is facing today. So we need to solve that for them today so that we can help them grow 6 months from now, 2 years from now, 5 years from now.
And yeah, I agree. It was the use case hook initially, but I think the biggest value that you have, and especially as you mimic the adoption curve of e-commerce, which I think everyone can agree is very small today compared to where it'll be in 10 years, you'll probably have the most rich data on some of these companies as they become powerhouses in their respective areas. So with that, I'll move over to Omer. Omer, I remember when we first spoke, and I remember I missed the first round because my fund hadn't closed in time. So I was trying to attempt to lead your very first round. Big regret on my part, or more my investors' part. But you know, I remember we started the model in the discussion early in, this was sometime I think in 2020, at the ideation stage around effectively lending, salary advances. But you know, very quickly you were able to understand that you know you can also leverage that same relationship with corporations to start doing overnight lending and to then continue to upsell to them in all sorts of ways. So I'd love to hear about that. And I know I've done a couple other deals where you've actually done financing as well in my portfolio companies. So you know, it's almost like you're becoming effectively a digital bank in the long run. So we'd love to hear the take and strategy that you're adopting?
Yeah, so I think at the beginning, the idea was clear focus. I think one thing that happens at the beginning is there's such a huge amount of opportunity in the market. You can easily get distracted along the way. So we wanted to attack a big problem that was going to be our first product to be able to launch. Now, giving out credit's very easy in the country. I'm not a huge believer of credit scores in the country either, just given the lack of data. The problem is, I mean, so there's a question in terms of AI. There's no data in the country. Well, when we're lending, majority of the people we're lending to, it's the first form of lending they've ever touched. So we're really creating the data, which then AI can analyze later. But for us, we're saying, okay, what is a big manual pain point that you can digitalize? I think this was something which I've seen from an investment standpoint where companies that have got it wrong and founders that have got it wrong have come to a country or even within country and saying, yeah, this is a massive problem, like payments, for example. I think payments is a useless business. And the reason for that is because if you ask the average person, their pain point is not, oh my God, I can't pay this person digitally. It's like, no, I don't have money. I need money. Now, what is a manual way that people are accessing that capital right now when they can't access it from the banks? Because we know that where lending penetration is in the country, it was very evident. And again, it's not a Pakistani thing only, it's an emerging market thing. In fact, happens in the US as well, is that people would go to their family and friends and say, spot me till the end of the month until my salary comes in. And salary cycles in Pakistan, as we know, are just super elongated. Or they'd go to their companies and literally ask the HR CFO and say, hey, can you spot me and cut it from my salary when it's done, when you do decide to pay me. And we said, let's just automate that. If we just automate that, put a balance sheet behind it, then we can see the pickup rate really happen. And so that was really the idea of going market with that first, but knowing that this was not going to be the be all and end all. There are so many other avenues you can open up from there. We use EWA, for example, as our hook product before we go into other forms of lending to the customer, should we want to, right? That's one aspect. But then, as you mentioned, going and working with the businesses themselves, and this is where we believe we're a truly embedded finance platform. The switching costs away from us are fairly high because we're now embedded into your working capital cycle. We're embedded into your employee base when it comes to their access to salaries. In fact, most of the time, we're actually processing the salaries as well. So we're really one of those high friction platforms that exists as almost a ERP-like system within your company. So the idea for us was that very quickly, as we started turning on clients, that there were other avenues for us to really switch on using our technology already to be able to just build the behemoth even larger. So as you said, we've been able to, our verticals, though it's all lending, and Abhi, the reason why we called it Abhi and not something like salary advance, something like that, for example, the idea was we wanted to make sure that we were addressing the real issue. When do you need money? You need it now, right? So Abhi is, we will always be there when you need capital now, and that's how we tie in both into the business side as well as for the employee base.
No, and I think you guys have done an amazing job in navigating that segment. So again, I'll go back to especially nowadays, if you're talking to people, how do you navigate the risk element? Because I know all three of you guys have done an excellent job in navigating that risk. So starting with you, walk me through some of the risk assessment criteria. Not obviously any trade secrets, but generally just so the general audience can understand. And the reason why I bring this up is because, look, we've had a lot of, I personally don't invest in B2C fintechs, like lending fintechs today, primarily, but the reason why it was highlighted earlier, it's a lack of data on consumers, and therefore your NPLs can just skyrocket very quickly. And we've seen that in some of the B2C side. So, wanted to kind of understand the strategy in terms of how to mitigate your NPLs. I know it's fair, it's pretty low on all three of you guys, which is what impressed me about your respective endeavors. But wanted to hear from each of you how you mitigate that component.
Yeah, I mean, just to kick it off, and I was touching on what Omer was talking about before in terms of e-commerce companies, for example, just not having the forms of collateral that a typical lender would want to be able to borrow against, because that's what collateralization is defined as specifically for banks, right? I think, and that's where the problem lies and the opportunity. It's definitions of collateralization. So definitions of collateralization are so wide, and this is why developed markets are where they are comparatively to developing markets is because there are so many forms of collateralization, which are not just land, not just your inventory. And which is where the risk aspect comes in terms of mitigating your risk when you are doing the lending, is saying, what is it that I can collateralize then? What is your core business and what can I collateralize against that should tomorrow you cannot pay? And by the way, majority of the time, it's not necessarily that the person doesn't want to pay, especially in this environment. Right? In this environment, it's not a matter of them not necessarily not wanting to pay and they're being straight up fraud. That'll always be there. I think in majority of the cases, that's less than 0.5 to 1% of your book. I think, and probably even less than that. The people who they cannot pay because of XYZ reasons, which we know from a macro perspective what's happening. So what is it that I can collateralize against for me to get comfort that I will get paid back? And so that's essentially where, again, it's not a trade secret, but that's essentially what we do to be able to mitigate the risk. We make sure that everything we do is collateralized in one shape, form, or the other. Now, it's not just land, it's going to be other things. And I think that's how we control our risk aspect of our portfolio.
Salman?
Sure. So for us, the secret to try and make sure that your losses remain controlled is to use what data is available, as long as the data has some characteristics which are important. Number one, it should not be self-reported. So for example, using data from self-reported income or general ledgers, etc., not very useful because can't rely on it. Data which is field surveyed because that has an agent problem, okay? An agent origination problem because the agents are normally more, compensated on loans that they can close. So you have an agent problem over there. So ideally, what you want to do from our perspective is to use data which is digitally collected by some third party. Now, what are some of the third parties that are digitally collecting data? So for example, PostEx is digitally collecting data on sales orders that e-commerce companies are doing. Now, there's a data stream that you can use to evaluate and score and get an insight into that business that is, that e-commerce business that's generating those orders. So generally, our model is built around trying to work with digitally validated streams of data which are related to financial transactions, either directly or indirectly. For example, obviously, a sales order is an indirect financial transaction, but that's a very strong financial component. So that's really what we use. So we look for those kinds of streams of data, and they're out there. It's not like there is no data in Pakistan. They're out there. You just have to find the right partnerships, work with the right data, and use them to craft a model that is specific to that industry or segment or vertical that you're addressing. And that's really what we've been doing for the past 3 years.
Amazing. And Omer, coming back to you on the same topic, can you give me some of your thoughts on how to minimize the NPLs?
I would agree on what Salman said, that first part is it's easier to get access to data, but to authenticate the data is more important because we have to see how verified the data is. I mean, is it authenticated data? And then that's something that you use to underwrite a business. That's the first part where you underwrite a business using verified data, can be from third parties, can be from your own system, where for us, we are working with them for logistics. So we know how much sales they're making. We know what is the return ratio for them or the success ratio for them. We know what cities they're mostly focused on. Each city have a different success ratio, return ratio. And then we even sometimes risk profile the products that they're selling because each product have a different consumer behavior, meaning that if you're selling t-shirts, it's going to have a different success ratio as compared to selling shoes, seasonalities. If you're selling warm clothes in October, November, your sales going to go up. But if you use the same data for the same merchant in February, you're going to see massive sales, but you know that they're not going to be able to make the same kind of sales in March, April, May, so for the following months. So yes, we have to first understand the data and authenticate it. And then the second part is where you need to have a recourse. It's easier to deploy capital. It's easier to give money, but what's really hard is how do you get it back? How much dependency do you have on them to pay you back? Do they have willingness to pay? Or the two factors that we have to look at, willingness to pay and ability to pay back. So most of the businesses, if we're working with them, we know they have ability to pay because we know their sales. And then we are underwriting, keeping in mind different factors, but do they have willingness to pay or not? But the less dependency on their willingness to pay, the better underwriting, the lower NPLs for us. So in our case for PostEx, it's logistics where we have control of the funds. I mean, the money is coming through us. We settle them rather than they settling us. So we take our whatever they owe us, certain percentage or whatever we give them as upfront payments or embedded financing products, and then we sell them for the rest. So for us, the recourse is as important as having access to data. And that's the reason why, like I said before, that we decided to scale our logistics, because we knew that if we don't have the recourse, we can't just lend and have dependency on them to pay us back, or having any dependency on any third-party logistics players to settle us on their behalf, because then there are a lot of moving parts. Then there are a lot of factors that are in play. And if they switch, we just don't have any recourse. So for us, recourse needs to be there if we're lending to any player.
Well, I think that's what I like about all three of these companies. You guys have done it you've taken a very tough market where basically there's no habits of borrowing, and effectively banks are parking money primarily in government treasuries, or effectively taking collateral and then doing 50 to 75% LTV to secure themselves. So they don't do too much unsecured lending. Most of bank customers themselves are unable to tap into financing. So what I love is that the fact that you guys have all three created a scenario where you're now lending to the end consumers indirectly, even if it's B2B2C, and then creating a transaction history and creating a data history that, in my opinion, it's an evolution process. I mean, a lot of times people take a snapshot of where Pakistan is today, but I think when we look back in 5 years, we'll see that the whole market is very different, and especially on the consumer side or in the SME side, a lot of the lending is going to be coming from fintechs. And that takes me into my next question, which is, again, the question is always around this: where do fintechs fit in comparison to banks? I kind of answered some of that or discussed some of that with you guys, but I want to hear it from each of you. Do you see banks as competitors, or do you see banks as effectively partners where they will offer the balance sheet in the long run once you guys have proven your respective models? Because ultimately, nobody can really compete with banks. They're the custodian of all the money in the market. But ideally, they should be leveraging you guys to lend, as long as you've shown that you've been smart with your data and your own lending practices. So, Omer, I'll give this to you first, and then we can rotate anti-clockwise or clockwise.
Yeah. So I don't consider banks as competitors. What are we good at? I think we're faster, just inherent because of being smaller, nimbler, and less legacy issues. I think that's one thing that is very difficult for large banks to do. It's an inventor's dilemma, right? When you already have massive cash cow business coming through, it's very hard for you to change your business model overnight, because you'd be killing the golden goose for you to be able to do so. And that's just not easy to do when you have, especially a lot of these banks are publicly listed entities. They've got their boards. They're making risk-free ROE from PIBs, like you said. Happy days. Why would you switch away from that? However, we view them as partners in the long run. I don't think it's happening quite yet. I think it's selective in a few cases, but this is, again, evolution of markets. If you look at Brazil, for example, it took a long time for the Brazilian banks to wake up and work with fintechs. If you look at, even in India, if you look at Indonesia, I mean, these are all markets that it took time. And I think we're still in the nascent phases in Pakistan for banks to partner with fintechs. And so eventually the idea will be that they will always have a cheaper cost of funds comparatively to us. Now, we've gone out, done a sukuk, et cetera, to be able to fund our book and grow our book from not just using equity. But I think the future of what it should be, at least, and how we view it, is that we would love to partner with banks. We will give you a good return on the capital that you provide us. You'll always have a cheaper cost of capital than us as well. And so let us go out and actually lend to the real market for us to grow the credit portfolio of the country. Because what's eventually going to happen, in my opinion, is that there's a reason why my APRs are higher, right? It's because I'm going after a segment that is inherently riskier. My NPLs will be higher comparatively to a bank. Now, what that allows me to do is then securitize that portfolio at some point and say, here you go, bank. You can now take this client from us who has now a 5-year track record, for example, of borrowing from me, but don't borrow from me anymore. You should actually be borrowing directly from the bank now. And here's the history behind it. Happy days. Yeah. So I think this is, again, just part of the evolution. And this happens in developed markets, a securitization of books to be able to move up the curve. And I think that's just we're just at the beginning of that right now.
No, you bring up, I mean, I was in shock when I moved back and I realized there's no MBS, mortgage-backed security market in Pakistan, right? They have very few mortgages, but in general, like you can't really have an industry unless you keep having securitization and churning of capital to create more liquidity in the market. And eventually, I do see taking banks coming in and different companies coming in, structuring loan books from all three of you, and then giving it a rating, and then having banks basically park money for yield based on historical patterns. Omer, same question, obviously. Would love to hear your thoughts on banks.
I would agree with what Omer said, that we're not trying to go up against the banks. If you look at the markets that we're serving, it's the markets that are being neglected by financial institutions because they're more focused on very secure lending. When we talk about e-commerce, when we talk about SMEs, these are not the markets which are being served by conventional financial institutions. I normally get a question where people are comparing fintechs with the banks and asking me that who's going to survive? Is it going to be the banks or is it going to be the fintechs? The answer to that is that we were supposed to work together. Like, so we're a layer where we're going to help them access the markets that were neglected before. And the only way to do it is if we do it first and show them with the data and show them that, look, the NPLs are down, like there are no NPLs to that extent. Like certain products that we offer, there are no NPLs. So if we share that data with the banks, we're going to win their trust, and then we're going to use their balance sheet to offer the services to the market. So we want to serve as much market as possible. When you talk about just fintechs going directly into the market, we have our own challenges when we talk about deploying the capital directly from our own balance sheet. So we want to have those partnerships where we can have them directly offering loans or capital to the markets that we are serving, so the markets can scale, and then we can scale with them. The only institutions who are not going to evolve with time are going to be left behind. It's not going to be the banks. It's not going to be the fintechs. It's just that when market evolves, everybody has to evolve with it. Let it be conventional institutions. Let it be fintechs. So the only gap that I see is that if financial institutions or the banks refuse to grow with the market or evolve with the market, that's where the challenge is. It's going to hamper the growth of the market that we're serving. It's going to hamper the growth of the fintechs and the overall economy of Pakistan as well. And it's our job to make sure that they see the other side of the market, which is being neglected.
Absolutely. And I think banks do recognize that in Pakistan, at least the bigger banks, they do understand that their credit committees are very focused on the Fortune 500 and that mindset for them. So for them to actually evaluate niche businesses is not easy. And I think that's where fintechs are really showing them that element of how this can be done with minimalistic losses. And I think you guys are pioneering. It's like really entering markets and building loan books that in a very tough environment and doing a good job at it. Salman, I left you for the last on this because I know you're already working with the banks and working very closely with them. So I would like for you to,
sure,
to get feedback from you on how banks are responding to your product, because I think that
sure,
that partnership is already taking place.
Sure. Well, but this is a question that's relevant for us because when we were creating AdalFi, one of the questions that we were discussing internally was, should we become an NBFC? Right? And that seemed the logical thing to do because everybody was becoming an NBFC. Everybody that's in digital lending, of course, you're an NBFC. So we chose a different route. We said, no, we will not become an NBFC. And primarily we chose the route because, first of all, we thought that we want to be in the infrastructure business and not directly in the lending business. Now the reason why did we choose that? Because if you think of lending as a pipeline, essentially there are three parts of that pipeline, right? So there's the origination part, then there's the underwriting part, and then there's the collection and servicing part. And all of this is underwritten by a balance sheet. So one of the questions we could never answer for ourselves was, how do we create that balance sheet? And how big of a balance sheet can we create? And what happens when we create a balance sheet in dollars and we're lending out in rupees and are exposed to a huge currency risk, which of course has played out in the last 2 years to all of our regrets. But that's a reality of Pakistan. So the way I look at it is the ultimate play for fintechs is going to be in being really good at those 3 layered pieces on the top. Any one of those 3 pieces or more than one of those pieces. You can be a great originator. So for example, PostEx is a great originator because you're uncovering customers that don't exist in the bank's minds. Abhi has done a great job of bringing on people through EWA, which banks weren't servicing, even though they might have been bank customers, but they weren't servicing them. So that's an origination play, right? Now, we're in the underwriting play, as we said, because that's what the scoring models are. And then, of course, because we work with banks' infrastructure, because in many cases, we as Technologics have implemented those systems, those core systems. So in many ways, we know them as well or even better than the banks themselves know the systems because we're the ones who put them in there in the first place. So we also play in the servicing part of the loan business because that, those systems allow banks to service. So ultimately, I think the lending fintech business has to move towards kind of the upper layers and not so much of a balance sheet play, primarily because, in Pakistan, it's not easy to create these balance sheets. So yes, you raise 10, 15, 20, 30, $50 million, but, compare that to the smallest bank in Pakistan, and that's $1 billion balance sheet. That's the smallest bank in Pakistan, right? So I think there is a huge play here, and I think there's a play here in partnership. But of course, before banks are willing to partner with you, you have to prove that point. You have to take the arrows in the back, which these guys are doing. Some we are doing, but these guys are really doing. You have to take the arrows in the back and show, put in that hard work of showing that a market exists, that you can actually lend to these people, not stack up huge NPLs, make money on them, and then banks would be willing to partner and lend out their balance sheets for people in the fintech business.
Exactly, amazing. I mean, look, this is the amazing part that, and one thing what I wanted to this for the audience, when we're investing, I mean, I myself, I've pummeled almost about 55% of my portfolio is fintech. I really believe in fintech in the sense that I think that this is the layer that's going to solve a lot of Pakistan's problems in the long run. Right? And I do look at it as a harmony with banks where, fintechs can't exist if banks don't eventually foray and offer their balance sheets. And based on what I'm seeing at HPL and Al-Falah and Mizan, for example, at least with some of the portfolio companies, they all have that interest to actually foray into this market and work with fintechs versus jumping in directly. From a broader perspective, I guess my question would be in the market when you look at it 5 years from now, where would, and this is just a general question, I'll let each one of you answer it, whoever wants to go first. Where do you see the market taking? I mean, rates. I think we're at pretty high rates today. These rates are going to drop. That's pretty. It's just a cycle science. But where do you see the market and adoption as a prediction, speculative, for fintech in Pakistan? And I'll let anyone that wants to take it first, I'll let them go first. So let's see who has.
Let me take it. Yeah, let me take this. So look, I think that I think this is from an industry perspective, from a fintech industry perspective, the events of the last 2 years are the best possible foundation for a renaissance in lending in Pakistan. So let me explain what I mean by that. You had to have a first event, which is you had to have people that were interested in investing in fintech in Pakistan. That was 2021. That was great. It allowed people like us to exist, because without that, we wouldn't even have existed because nobody would invest money. That was the first thing. The second thing that had to happen was we are in a historically challenging lending environment. KIBOR has never been higher than this in living memory, right? So what that means is that anybody who's in the digital lending business who isn't very good, and of course, its KIBOR is high because the macro is bad, right? So anybody that's in the digital lending business who isn't very good is going to get weeded out, right? They will lose their shirt, and some fintechs have already lost their shirt and they've gone out of business, right? Because they're racked up losses and unsustainable losses. So in a year from now, 18 months from now, the companies that merge in the fintech business will have established that they could lend profitably with low NPLs in the worst lending. And we want to create the foundation for banks to say, yep, this works. Let's partner with these guys. They know how to do it. Let's partner with these guys, and let's really now, turn on the spigots. Let the credit flow big time, because right now it's still small bucks, just because the balance sheets aren't that high. From a fintech perspective, turn on the spigots, let the money. So really, 5 years from now, I see a major credit renaissance in Pakistan. Okay, that's my little take on this.
No, I think that's amazing. I mean, you've gone to that evolution thing that I think every market evolves, and when you see the toughest environments and companies that survive are not just going to survive, they're going to thrive. So I'm of that same opinion, and that's, by the way, across sector, in any vertical in tech. I think that's going to be the case going forward with fintech specifically. Omer, who wants to go next?
Yeah. Thank you. Yeah. I mean, Salman summed it up that in 18 to 24 months, we're going to see startups turning into businesses. Like venture, we used to have that mindset where we just have to scale. Now that has changed, given that it's really hard to fundraise in this market. And then startups have changed gears. Like they've started thinking like businesses. And when you start thinking like a business, you start making profits eventually. So 18 to 24 months, we're going to see winners. But this is the time where you're fighting to be a winner in the market. And when we have 2 to 3 winners in the market, then they're going to scale, given that the bank's going to back them, then given that they will have more access to capital, let it be external capital or local capital, international or locally raised capital. And then that's where we see massive use cases just for Pakistani market, because we have always been comparing our market to markets around us or other emerging markets. And we have started to believe that if something has worked in India or in any other emerging market, it's going to work here as well. But this is a very unique market. And this is the time that's going to decide which products going to scale in this market, which are made for this market. And then in 5 years, we're going to have those startups scaling and really serving massive markets. And then they will be expanding out of Pakistan as well into the similar markets.
Absolutely. Well, Omer?
So I think we're already there. My viewpoint is that I kind of disagree with Salman in the sense that this is actually the best market to be lending in. I think this is a very lucrative market for you when you're a lender. I remember when a couple of years ago, actually a year ago, I was sitting with probably one of the largest fintech lenders in Egypt. And he asked me, how's the market? And I said, you know what? We've got the one commodity that everyone wants, which is cash. We've got pricing power, which is great. And the traditional banks are funding PIBs. So we're getting almost very good credit rated companies and lending them at rates that they would never pay otherwise. And he said, you know what? He said, you know what my best years were in Egypt? And I said, what? He said, the revolution and the currency crisis. So point being is,
wait,
we're already...
Isn't that still happening in Egypt?
Yes, it's still happening. It
Yeah,
is exactly.
So he's still thriving.
Round two. So you just look at his numbers; they're probably skyrocketing again. And so my point being is that we're already there, and this is the renaissance has come because people need access to funding. Now, who's going to come out of it is those who know how to actually build balance sheet businesses. So good for you if you're able to raise equity, but can you actually source local debt? Now, forget about if the banks can't do it for you. Well, don't just sit back and wait for the banks to do it. You got to figure out a way for you to fund your balance sheet to go and build in this market, because my belief is that market share is won in down markets, not up markets. A monkey can win market share in up markets. So this is the time when people require borrowing. If you can build a formidable enterprise during this time, the renaissance is here. If you skip this, then you're going to come out of this with a flat loan book, and that's useless. So I think this is the time where you can actually start building a real business.
No, I mean, I can see it in the back end. All three of you guys are thriving. So if this is what's happening in a high interest rate, unstable macro environment, I can only imagine how things will be in the next cycle. Very, very excited about the future. I think we should jump into Q&A because I'm seeing a lot of questions. Hopefully they're not really negative questions. I'm too old for this, man. I'm on a tablet. Omer, you're the youngest one and athlete here. Can I have you start reading the questions?
Yep.
So why don't you pick and just start shooting? Yeah, start shooting them to everyone. Okay, go ahead.
So there's a question for Omer. The early stage access can have negative impact to employees as it impacts and veteran, or what's your take on it?
I view it the opposite, obviously. I mean, I may be biased, but the idea is the inherent system of how wages are paid is archaic. If you think about it, you are actually, as an employee, lending your company money for 30 to 45 days before you're actually getting what you're due. So if you've worked today, you deserve to be paid today. Now I understand probably where you're coming from, and the idea that percent of your earned wages, and so it's impossible for you to actually get even beyond your 50% DBR. All we're doing is democratically allowing you to access your wages in real time. So we just fundamentally disagree that it actually impacts it negatively when it comes to the employee base.
And there's a question for Salman. Do you think open banking would come to Pakistan? And if yes, how would that impact your business?
It's going to come because it just makes too much sense for it not to come to Pakistan. And if it were to come to Pakistan, that'll be great. It'll just it will just eliminate one more source of friction in accessing data for for prospective borrowers. Because right now, there's if you don't have that data, if it's a prospective customer and don't have access to the bank information, then you need to go a physical poll and blah blah blah. So yeah, open banking, it would be great. It would help everybody in the fintech industry. It would help the banks themselves. So I hope the SPP is listening, and I hope they mandate open banking as quickly as possible.
All right. So there is a question around access to capital. Like, are lending startups using their equity to lend in the beginning before they achieve a success ratio and subsequently unlock capital from banks or market?
So I think we already answered that question, right? So, yeah. So we've already answered that question in quite some detail, right?
That's true.
Yeah.
So when we talk about having access to capital, obviously it's really hard to really scaling from your own equity. So initially, yes, we have to do it to get access to certain data, to understand the business, to understand the market that we're serving. But when we start scaling it, yes, we need to have partners like banks or financial institutions. But then it's about what kind of access to capital we have, right? So if you're raising debt in the market, so we're like a financial layer between capital and market. So if you're not using our own equity, we are bridging the gap. And it depends on what terms we have access to capital, right? So if it's a very high rate, that if the debtors are giving us at a very high rate, we eventually have to pass it on to the market. And we have to see what kind of terms we are getting from the lenders or from the financial institutions or whoever is giving us money, because we're going to have to pass it on to them. We're not like a conventional business where we need access to capital or we are raising debt so that we can have another facility. What we need that capital for is so that we can pass it on to the market. So it's really, for me, it's very, very critical that having capital or having access to capital is as critical as that what rates we're getting that or what terms, because that is going to have impact on the market that we're serving. If it's at a very high rate or if the APR is very high, or if the terms are not very favorable, then it's not going to be good for business, or it's not going to be good for businesses that we're serving or we're expecting to grow, because we're not trying to just make money today. We want them to grow first, and then we want to grow with them. So if you just try to take an opportunity and see that, okay, look, we can offer them 35 or 40% APR and then make money right now, it's a short-term win for us. But in long term, we don't see that as a win. We see that as something that is going to hamper the growth of the market that we're serving. So we need to think about the market, and then we need to move towards making money or growing with the market. That's my take on
that. There's another question specifically asking, are PostEx and AdalFi expanding outside of Pakistan? For Abhi, what percentage of business is in Pakistan? Since I guess Abhi's already started expanding. So guys, why don't you give your respective feedback on that, on your thoughts of regional expansions? Omer, maybe you can take the lead on this one.
Okay.
No, Salman, go please, Salman.
No, I was just going to say, look, from our perspective, so right now we operate in Pakistan, and our focus is very much on executing in Pakistan. We do think that the problem that we're solving, the scoring problem and the digitization problem, is endemic to EMs, but all emerging markets, but also all the way up, even in the US, which is the most credit sophisticated market in the world, there is a thin file, no file credit scoring problem. So these problems exist in some way, shape, or form pretty much across the world. So we definitely see this as a hammer that can address many, many different problems. But for 23, our focus is on Pakistan.
Makes sense. Where?
Yeah, look, we regional expansion. We started that last year. We're in Bangladesh. We're now live in the UAE. I think it's important from unfortunately, look, I deeply believe that Pakistan is a hugely untapped market, and we're just going deeper and deeper in Pakistan, hence our Sukuk, etc. And we will continue to fund that business now with local capital. However, you have to face reality that unfortunately, from a global perspective, Pakistan just does not rank well from an allocation perspective. So you do need regional expansion for you to be able to tap other forms of capital if you plan to build. Bangladesh helps us do that. UAE helps us do that. But what's important is for you to do it in a cost-efficient manner. And that's what I think allows you to be able to do it from somewhere like Pakistan. So we've built everything in Pakistan. We're still using all our team, our efforts from Pakistan to be able to enter new markets where we're able to literally scale much quicker comparatively to other people because we have already set products. It's software at the end of the day. It's software backed by a balance sheet. So for us, we've really been able to take advantage of that. And so I think regional expansion is something that has to be on the cards if you are looking to build a larger startup, which is looking for exit capability as well. I think that's something which just will not come from Pakistan alone for the foreseeable future.
And I think Zameen and Kareem have kind of put a pretty good playbook. I mean, even though Zameen is started in Pakistan, Kareem was regional, but they both leveraged the talent and tech resources in Pakistan and expanded regionally. Omer, what are your thoughts on regional expansion?
If somebody had asked me this question 12 months ago, I would have said that we just want to focus on Pakistan because we are scaling in Pakistan, we're growing, we're aggressively targeting market because we want to win the markets. Yes, we want to make money. Yes, we want to scale, do the fundraising, but at core, we want to win the markets. 6 months back, we won Alhamdulillah Pakistani market, meaning that we have been leading Pakistani market in the services or in the industry that we are offering our services in, or let it be logistics, let it be giving access to capital for e-commerce platforms. So that made us think about expanding out of Pakistan and solving the similar problems in those markets. Not using the same use case, meaning that we don't see that cash on delivery is so we don't see UAE or KSA to be as cash on delivery intensive market as Pakistan is, but we still see similar problems, meaning that e-commerce there still doesn't have access to capital, meaning they cannot go to the banks, let it be UAE or KSA or any country in Middle East. So we see those problems there, but we don't want to go there so that we can have a bigger portfolio of countries that we are offering our services in. We want to go into those markets and win those markets. So that's the reason why we decided, okay, look, we have a team that is executing. We have a team that knows how to win markets and retain the business and keep scaling it. Now it gives us some flexibility to focus on one more market. So one market at a time, and we want to win those markets, whichever market we go into. We don't want to be there just for sake of being there.
So I think one thing I will add to that is that while it's important to scale regionally, I think all three of you have a unique model where you do have the ability to go regional, but I don't think it works for every single type of vertical, because if you're going to enter a market where your competitors in the other regional markets are way further ahead, you're going to lose your shirt. I mean, we've seen that even happen with when the market was booming with some of the companies that entered Pakistan. Trucker from UAE, you saw Trella from Egypt enter Pakistan, and eventually they had to pull back. And even with checkout, they eventually started scaling back in Pakistan. So those things, some food for thought for the audience out there. That doesn't necessarily apply for every model out there. I think if we have time, we can take one more question, but I think we're pretty much on the dot on time. Gentlemen, what I'll do is I'll leave you with each with a quick parting thought. So I always like to do that because what you see, what your aspirations are as a company for the next 1 year. So give me, or what your outlook is for the market in the next 1 year. We've kind of touched upon that already, but just a brief one. So I'll start with Omer.
Yeah, it's a tough one. Look, I think for the next 12 months, our focus is, I think, lucky from the beginning, we've been focused on cash flow. So we're profitable, we're scaling. And our idea is I want to at least triple our revenues in that period of time. I want at least 30% of our revenues coming from outside Pakistan. And I want us to go deeper when it comes to the debt markets in Pakistan itself. So I think the idea for us is just to be bigger, stronger, and come out of this crisis, as I said, having a much larger market share comparatively to everyone else, to really set the precedent for what I think is going to be the next foundation for Pakistan's boom.
Salman?
Sure. So next 12 months, we see, first of all, the set of credit products that we enable banks, at this point, we've pretty much got all of them rolled out in one bank or the other. So one part of our game for the next 12 months through the end of 24 is making sure that all of our 14 bank partners that have already signed up with us do the maximum adoption of these 4 credit products that we enable across their portfolios. So that's one thing. That's sort of more of, sort of day-to-day, sort of tactical stuff. But 2 other things I'd like to focus on. One is to partner with more NBFCs. Our focus has been on banks, but we already partner with 2 NBFCs, but we'd like to partner with more NBFCs and see if there's a fit over there where our products and our focus and expertise can help them in their journeys. And hopefully by the end of 24, we are in some regional market. So that is for 24. That was definitely one of our objectives. That by 24 we've launched in some regional market at the other. Okay.
You got 2 NBFCs here. That I think you should talk offline after this.
I know. I was wondering when they'd get the hint.
Well, Salman, I think we're already somewhat working together through another.
Yes.
Omer, I was going to tell you, I'm going to connect you afterwards to explore some of your. Omer, your thoughts on the next 1 year.
So we have around 20 to 25% of the market share right now when we talk about e-commerce. We want to make sure that we have over 50% of market share, meaning that we can beat the market. That has always been the goal. We have never been more focused on any player in the market rather than we wanted to beat the market. So we're very close to that. In next 12 months, we want to inshallah achieve that. And then we want to have a very clear roadmap to be leading one more market that we step into. So that's where we see ourselves in 12 months, inshallah.
I think Omer is taking notes for Blue X. I'm just kidding. All right, guys. It's been a great session as always. I always enjoy speaking to each one of you individually, and it was great to actually have all 3 of you guys on one platform. So thank you very much for joining and staying with us late in Pakistan and early on the West Coast in the US. But look forward to further comments from people. Thank you so much. Thanks. And thanks, Ali.
Okay, thank you.
Launch and everyone.
Thanks, Faisal. Thanks, everyone.
Take care.
Okay, bye.